First idea, Alphabet, aka Google.
Right, so Alphabet, as people know, is the top search destination on the web and provides, I think, leading marketing platform for advertisers and merchants. So I think one of the important things about that is that even though you think advertising is going to be maybe slowing down because we're going into a recession period of time, Alphabet controls about 30% of the share of digital advertising and revenue from digital advertising. And revenue from digital advertising in 2024 even is probably going to be about $400 billion. So I think, they really control a fair bit about that. That's one thing. The second thing I think is that YouTube is shown to be a great place to monetize advertising. Although you saw a slower growth in it in the last couple of quarters, I think that that'll continue to grow. The stock trades at 20 times our estimates of earnings. It has $50 billion, generates $50 billion of free cash flow a year. So for us, it's a great opportunity to own a great business. I think that some of the restrictions that Apple has put on doesn't affect Google. So you have to remember that they have their own operating system. So it has a very different impact than what that happens to Facebook or Meta. So I think Google is a great opportunity. These levels, you're buying a great company that beats its cost of capital on a consistent basis and does very well. So.
Okay, we got Zoetis, the pet health giant, ZTS, in New York.
Right.
Why do you like this one?
Well, so Zoetis is it was spun out from Pfizer. It is the largest animal healthcare company in the United States. Pet owners spent about $15.5 billion in 2018 relative to $6.2 billion in 2001. So it's a really growing area, and they have two businesses. One is livestock, which has done poorly over the pandemic because people were eating less. Like there was an issue with that, and protein, et cetera. So restaurants were closed, et cetera. So that's increasing, and that probably just grows at 5%. The real growth comes from the kind of animal pet care business, and that's growing quite substantially. And healthcare for animals have a certain advantage over humans, right? The industry doesn't have to contend with pricing pressures from insurance companies, although that's increasing, but a lot of stuff is paid out of pocket. Sorry, there's developing drugs compared to humans is very different. It's a lot faster, it's a lot less expensive, and it requires sort of less clinical trials. The company's got a great balance sheet. There's not as many generics that they have to face. It generates about $2 billion in cash flow this year. And so I think they've got some great products coming through the pipeline over the next sort of several years that'll help them grow against their competitors.
And finally, First Service. Why do you like FSV?
So First Service is a great Canadian company. They're in the residential property management business, and they do what they call franchise business. So call it California Closet, Paul Davis. So what's unique about this business is that it's a very low capital intensive business. There's not a lot of CapEx. They've grown two ways. The first way is that they've grown through organic growth. And the second way is that they've made some of these kind of what they call tuck-in acquisitions. The industry is very fragmented, so they still have a great opportunity to grow over the next several years, specifically in the United States. So that's an important aspect of what they're doing. The other thing is that they are slightly inflation protected because a lot of their contracts have an escalator for inflation. That's the other thing that's important about it. It's heavily based in the United States. And the last thing I would say is that they have this, it's an annuity. There's a slight annuity in the business. And what I mean by that is that if you give them a contract to manage your apartment building or your property, it's not something that you change every year. You tend to review them over a certain period of time, 3 to 5 year period. So there is that kind of, you get that money on an ongoing basis. So it helps you, protects you through kind of difficult periods of time. So from my perspective, it's a great Canadian business. Yes, it trades at a higher multiple. It doesn't have much of a yield, about 1% yield on it, but it's a great time to be buying the company. It executes incredibly well, and management is very strong and owns a lot of the shares of the company.
Is there any other real estate stocks you like? Any of the REITs you're holding, apartment REITs, for example?
I like Summit, which is an industrial REIT. I think that there's still a lot of growth on the industrial side, and I think that Summit is kind of a great company to own for that. I don't want to own commercial properties. I think that's a little bit more difficult. I don't quite understand how working from home and all that stuff is going to affect any of these companies over the next little while. The apartment REITs, I think, will do well because I think if you continue to see increase in rents and there's more, obviously there's more being built, so there'll be more competition, but I think that that's an area that we like as well. But I do like the industrial side. First, it's considered, it gets put into that REIT bundle, but it's a very different company altogether. So I think that it's not a REIT in that respect.